discussed so far the income statement, the balance sheet, and the cash flow and the working capital. Now we are going to look at financial ratio. What is the utility of financial ratio? The utility of financial ratio is it establishes relationship between different numbers of the balance sheet and the profit and loss. Thereby, you are able to arrive at meaningful conclusion with regard to that company. There are four broad categories of financial ratios which are used globally by all the market operators, investment analysts, financial analysts, investment bankers, lenders, investors, financial controllers, everyone. So, which are the four categories of the ratios which are used by people for coming to conclusion about a business? The number one is liquidity ratio. What is liquidity? Please understand. Liquidity is ability of a business to take care of its financial obligations in the short run. Meaning what? Meaning company should be able to pay to its creditors from time to time without any difficulty whatsoever. Company should be able to pay all its statutory dues, should be able to repay all its loans on the due dates. That is your liquidity, ability to take care of its short-term obligations from time to time. The second type of the ratio that we have is profitability. And I'm sure all of you as employee, as vendor, as customer, as government, you would always be interested in a company from its profitability point of view. You would always like to find out whether a company is profitable or it is not profitable, and look at the profitability from different angles. So that is the second category of the ratio, which is known as profitability ratio. So to get an idea as to how the business is performing, because ultimately a business will be interesting only if it is making profit. If it is not making profit, the business will not be interesting, because if I put my money into a company which is incurring losses, remember my investment in that company is going to sink sooner than later. Third category is activity ratio. What is the activity ratio? As the name suggests, activity ratio tells us about the activity of a business. Activity in terms of utilization of the assets. And I'm sure you can very easily understand which is going to be a good business. A good business is going to be one which is using its assets more frequently, more vigorously, and because more you use your assets, more sales you generate, more profit you make, better company you become. So that's your third is activity ratio, and the fourth is leverage ratio. Now, what is the meaning of leverage? Remember, friends, it's very simple. Leverage simply means, are you using borrowed capital in your business? Are you using loan capital in your business? So if in our business we are using loan funds, borrowed funds, debt, that means we are a leveraged company. If we are not using debt, if you are not using loans in our business at all, that means we are a zero leveraged company. That means in our company there is a zero debt. But if a company has taken too much of loan, that means this company is known as highly leveraged company. So what is the meaning of highly leveraged company? The meaning of highly leveraged company is this company is using a very high component of debt. Is it a good sign or bad sign? Apparently, using too much of debt is a bad sign. Why bad sign? Because if you are using too much of debt, that means what? That means it can happen that because of slowdown in the market, your profit may come down, your cash generated from the business may come down, and that cash may not be enough to pay the interest on the loans that you have taken and to repay the loan that you have taken. And that is why highly leveraged companies which are using excessive borrowing are considered to be very risky company. And that is why, please remember and make a mental note, Any company which is highly leveraged company will always get very low valuations on the stock market. And why do they get very low valuations on the stock market? Because people think because of high debt, this is a risky company. Since it is a risky company, the value goes down. Since the value goes down, people are not interested in buying those shares. Since people are not interested in buying those shares, the prices of those shares keep coming down. So that is what we need to remember. The four categories of financial ratios. Number one, liquidity. Number two, profitability. Number three, activity. And number four, leverage. Now what we would do, friends, we would look at them one by one as to what are the ratios under these four categories. But before that, as always, open to all of you for any question that you may have.